anyways, I'm a farmer's agent, been with farmers, I think 12 years now, so it's been a while. I have the unenviable task of trying to make insurance interesting today. So in order to do that, my slide presentation, I didn't make it all that graphic and cool and make sounds and stuff like that. So I'm gonna rely on you to ask questions whenever you want to. You can pause me if you have a question about something. And then also interaction. So please, there are a lot of places where I want you to ask questions and make it interactive. That'll make this a little bit more exciting when it comes to insurance. And I think I got everything Omar wanted me to cover, but certainly at the end, there's time for plenty of other questions if you have questions about specific things that you deal with, because I'm sure you all have specific probably heartaches when it comes to insurance or things that you don't quite understand. So hope I can walk you through those things. So my office is in Burbank. I live in Valencia, so kind of between both places, but I'm there in Burbank. First and foremost, what do you need for a homeowner's insurance quote? First one, property address. Surprise, surprise. Second one, occupancy. This is really important. This is something that a lot of people miss, and it's really important because if it's insured improperly, there could be coverage issues. If you have something insured that's owner occupied and there's a tenant in there, certain insurance companies won't pay the claim. Farmers would, but then there'd be an issue after. Some companies would just say, we're not even going to pay the claim. So making it clear about the occupancy is important. Now, on the lending side, there are times that maybe the lender has to know it's a certain type of situation, and then maybe it's going to change. So that can be worked out with your lender potentially. Like sometimes someone's saying that they be owner occupied, they might end up renting it. Sometimes there's even a rent back for 60 days. If it's less than 60 days, you can do the homeowner's policy. If it's longer than 60 days, the rent back, they got to start with basically like a landlord protector, because in a sense, they're really renting it to the new owner, or I'm sorry, to the old owner for the first 90 days, let's say, right? So you got to be a little careful with that. So if you know you're going to do a rent back of more than 60 days, you've got to let the agent know so they can properly handle that. Client's date of birth is important. Sort of the older they are, the rate's better. Until about 80, and the rate starts to get a little higher, right? So they want adults in there. 35 plus basically is going to get a better rate than, let's say, a 20-year-old. And again, up to about 70 or 80, then the rate's going to be a little lower because the concern is maybe the older person's not going to take as good a care of the home. Also, all the other adults that live in the household. So if you have one adult in the household, it's one rate. If you have a second adult in the household, you're going to get a discount, because then there's two adults, figuring one's home, one's not home. So actually a second adult's important to have. So if there's more adults in the household, you gotta let us know. Property features in general, the roof type is one of the most important, whether it's asphalt, tile, that kind of thing. Some situations where there's flat roofs can be a coverage issue. Most insurance companies do not like flat roofs that are rolled rolled asphalt. That can be a problem. And doesn't mean they can't do them. You just might have to be a little more creative in where you place that risk. The pool being there is super important, especially when it comes to liability on a policy. Whether or not the garage is detached or detached, porch, a deck, other features that are important on the property. Really these days, Zillow is my best friend, or I can look on your actual listing for the home and I can find the features I need to find anyways. That being said, generally within 48 hours, I'm gonna go out and inspect the properties as much as I can. And the client's professional background. I put that down only because it's usually a discount feature. Like Farmers has huge discounts for firefighters and teachers, doctors, lawyers. Real estate agents get 15% off the home policy, for instance. And so that's why client's background is important. Omar will always send me the basic information. I'll come back. What do they do for a living? And that's why that's important.
Question.
Yeah.
On the drive-by, you're doing a drive-by inspection, or you have to call?
I do a drive-by inspection,
Okay.
Yes. Yeah. I mean, I don't even get out of the car sometimes. I mean, just because sometimes it's awkward. I will wear my farmer's shirt in case there's an issue. Granted, a lot of these homes are in escrow, so, it's not usually a big deal if the home's vacant, but yeah, I don't want to disturb anybody.
Okay.
Yeah, please.
So if it's like a triplex and then you have like one person move out and that was a 20-year-old, now you have a 30-year-old living in, you're constantly having to let you know, or?
Not necessarily. Really, it depends if that's a rental property, it's not a big deal at all. It's just going to be written up as a rental property, right? Or like a landlord protector policy. So it's set up for that situation. If you have a duplex, maybe where you have an owner occupied unit in one and they rent the second one out, that's fine. It would be considered owner occupancy because at least 50% of it's rented, is by the homeowner, right? So yeah, good question. But yeah, generally a triplex like that's going to be where it's going to be all three rental units probably. So not as important, but yeah, the occupancy is something to certainly consider, and just talk to the agent about it. Hopefully me, if you use me only. Absolutely. Let's see here. Why is the insurance required? Most important thing in terms of the lending side, that's how you're going to close escrow. Without it, you can't. Really, what you're doing is you're protecting the lender's interest. That's what they care about the most. Really, the client's interest, though, is just as important. then in the end, what kind of insurance is required is where I'm kind of going next here. So just in terms of the coverages that are available, the most important one, it's called coverage A in the insurance world, is the dwelling coverage. And that's really the amount needed to rebuild the home. And the biggest sort of misunderstanding here is someone's buying a million two home right over here in Pasadena. Why is the coverage 1.2 million, right? Well, it's not how it works. You don't just, house doesn't burn, they pay off your loan. That would be great, right? They don't do that. The house burns down, you got to rebuild the house. Then if you want to pay off the loan, you got to sell it, okay? So that is why it has nothing to do with the price of the value of the home. You have a 1,000 square foot shack in Malibu, it's going to be 1.5 million, but 1,000 square foot shack could be rebuilt for $100,000, right? So it has to do with the rebuild cost, not the value of the home. That throws people off all the time. On the lending side, what's become an issue, and we're going to get to in a minute, is that the lenders want to see it's a million home. Why isn't it insured for $1 million, right? But I just explained why it shouldn't be. So now we get to the point where they're requiring the cost estimator, and Maria here can tell you I'm sending those all the time. We're about to get to that. So that's dwelling coverage. Kind of what I just said. Yeah.
So it is important regarding that cost estimator because more and more investors are asking for it because they want to make sure that there's proper insurance coverage for the rebuild, right? A lot of it, it's good to know work with an insurance company that's reputable, or at least an agent that's reputable, because they'll send the insurance, the evidence of insurance, but they don't send that estimate. And then we are waiting another day or two just for that estimate, and it's just, we were asked for it the first time and they don't send it, and it's just very irritating because that alone can cost us an extra day or two. You know, that's how important that is in a time-sensitive contract. So that's how important it is, and it can be a problem.
Yeah, and again, I'm going to get into a little bit. Well, it's right there at the bottom. Today, we use a 360 value program, which is a cost estimator that accurately ascertains what it will take to rebuild a home. So based off the photos and my inspection, the type of roof, the type of foundation, whether it's a crawl space or a pier and beam, or if it's a concrete slab, those are all things that really affect that reconstruction cost. And so it's important that I do it correctly. Okay, and in the end, when you send out the evidence of insurance and the 260 value in this case, or the reconstruction estimate that Omar's talking about, that's putting me on the hook. I'm saying this is how much we're insuring it for. And that's a number I need to also work with my client on, because if they want to get a little extra insurance, they can. I don't generally want them to get a lot more than what the cost estimator says, because they're paying for insurance they're not going to use. If the farmer system says we can rebuild it for 400,000, we're going to get that done. And if we can't do a 400,000, Farmers as a company, not all companies have this, but we have extended replacement costs built into our policies. So another 10 to 20, even 25%, depending on what the client wants, is there. So if there's a demand surge in terms of after a fire, the prices of wood are up 10%, that's part of what that extra buffer is for. The other part is in case as agents we make errors, right? But our system's pretty careful. If you change it all of a sudden to a different type of roof, it's going to be another $20,000 the reconstruction cost. And so that's exactly what Omar was just talking about. Yeah.
You might be discussing this a little bit later. What if, let's just use Pasadena. What if it's a craftsman home that was built 100 years ago?
Yes.
To really replace that.
Super important question and great. And that's what you want to watch out for. If there's a really low ball number, like I have a craftsman home here recently that was 3,000 square feet. If that was a traditional home, 550, 600, more like $900,000 of coverage was needed there. And so on the box of this 360 value, if I were to bring it up on the computer, it says, do you want it to have period touches, restoration at the period, at the date of it? And so that is in that part of that process. And this is all redone after all the fires, not these fires, but the station fires about 6 or 7 years ago. This whole industry changed to where now we had to go through all this training as agents, not just farmers, but all insurance agents in California, to have a program like that to make sure we're insuring them properly. Because after the station fire, there were all these claims. And what ends up happening is it goes on our E&O. Just like malpractice insurance, I have it. Never had a claim, hopefully I never will, but I've got a $5 million policy to cover me in situations like that. So that's why it's so important. What I see a lot of time actually is I see a lot of companies probably overvalue a home, and they'll have a reconstruction estimate at $750,000 for a tract home in like Valencia where I live. We would never pay $750,000 to build rebuild a tract home unless it's one of the really specialty homes. It might be more like $500,000. So another company might just be adding way more coverage than they need, and the client doesn't need it. They're paying for coverage that would never be used.
Is that against the law?
It isn't. It isn't. It's not. But that's why the client should look at it and go, why is it so much, right? Sometimes it's part of the package, which I'll show you later, but generally speaking, I try to be as accurate as possible there, and there can be differences in the number there. Some companies want to insure it higher. Farmers really tries to make it accurate. I think there are times that our system probably undervalues it, and I'll bump it up just a little bit. So moving along. Okay, so this is all I've talked about already. As home prices have soared, the cost estimator is so important because it really is telling you what it costs to rebuild the home. And that's what Omar was talking about, the evidence of insurance. And the lenders these days, they used to accept some policies that might have been somewhat ACV, which is not replacement cost. We'll get to that in a minute. But nowadays, really, it's got to be replacement cost. If it doesn't say replacement cost on the EUI, some companies just will not do the loan. In fact, really, anyone, Omar, you guys work with, it's got to say replacement cost, and that's important. And like he talked about, they want the evidence of insurance and the cost estimator. I earned the big bucks from Omar's team because I am pretty quick most of the time at getting the evidence insurance. And he can tell you about nightmares with AAA, other agents where it takes 3, 4, 5 days. Honestly, I can get that stuff done in like 10 or 15 minutes, a matter of me getting to a computer and doing it. So it's not a hard thing to do. These other companies that take like 4 or 5 days, I don't get what they're doing. So I always guarantee I'm gonna get something to you guys, hopefully within the hour, within 24 hours at the most. So I'm glad those other companies seem to slack in this area because it helps me.
I'm sorry, before you
Yeah,
go on,
please.
that key term replacement cost, can you just, will you explain what that means one more time?
Yeah, it's just basically what it costs to replace the house as opposed to a depreciated value. The other term is ACV, actual cash value, which is basically you have an old tube TV, they're gonna replace it with a tube TV, right? But now it's like, even if you had a tube TV in your house, we're gonna replace it with a brand new plasma TV because it's the replacement cost of what a TV is now. Similar on a home, right? We're not gonna take depreciation out of it. We're gonna pay you whatever it costs to rebuild it to how it was. Okay, and that's what the companies want. There are some exceptions when it comes to vacant homes and other things where they might allow an ACV component, but we'll get to that too. Other structures are important, detached garages, casitas, sheds. These can be overlooked, but they're super important. That's part of the loan. I mean, if the casita burns and it's worth $50,000, the lender cares about it. So making sure you have the appropriate separate structure coverage is important. And I'll talk about generally how that gets assigned in a bit here. Personal property is what it is. Furniture, clothing, electronics, all that kind of stuff for the client. Loss of use, super important. That basically is gonna rent you the hotel or replacement home while your home's being repaired. After a fire, it might be 3, 4, 5 months. I have some clients that just got back in their homes after about 15 months of the fires out in the valley. Actually, it hasn't been 15 months, but it's been about 10 months, but one of them just got back in now. So it took a while because they had smoke damage. It just took forever for the restoration company to get out of the house. Separate is loss of use. Rental property is different. Loss of use is not the same as loss of rents. Loss of rents is how much you're renting out for every month. So finding out how much they're going to rent the property out for is important to make sure they have enough coverage to have at least 12 months of coverage when it comes to loss of rents on a rental property. Liability, what it sounds like, is coverage for third-party lawsuits. Ordinance and law, this is a very misunderstood one. This is super important. Really, the big companies have ordinance and law built into their policies. So a Farmers, a State Farm, or AAA, they're the big companies out there have this built into the policy, generally at 10 or 25%. And what is ordinance and law? That basically means that if this building is rebuilt now, I don't know when it was built, but maybe in the 60s or something, if it was rebuilt now, they would require sprinklers. It already has sprinklers. But let's say it didn't have sprinklers and the code now requires sprinklers, you got to pay to bring that in. A lot of insurance companies exclude that. So anyone that bought a house, let's say after 1994, the codes have changed because of the Northridge earthquake, right? A lot of codes have changed throughout all of LA or all of Southern California. And so now there's that issue of ordinance and law. So like Farmers, for instance, we build an automatic 10%. But you've got to make sure your client asks, especially if it's going to be an older home, right? If it's built back in the 20s or a Victorian, like you were talking about, or a Craftsman, this ordinance and law can be super important. I have Craftsman's, I have a 50% ordinance and law coverage for that reason. So just little tidbits. That's really what a good agent will tell your client about.
Real quick, on the loss of rents, are you still entitled to that even if the property was vacant at the time of the accident?
Maybe. It depends on how the policy is endorsed. We'll get into vacant policies. They have different rules because they're vacant and insurance companies hate them. Yes.
We're gonna say it's rented as paying cash.
If you have a property and you have a garage in back, are you as the owner going after insurance allowed to say, I don't care if the garage burns down? Can you edit, like, can you qualify what you want covered on your own property?
Yes and no. There are some situations where you can exclude it, and sometimes you get it where it's a great property, but the garage is not even insurable. It's in terrible shape, and I can actually exclude it, and you can just sign an exclusion form. Or it depends on the policy. If it's a package policy, the separate structure coverage will just be automatically at 10%. But again, I'm going to get into that in just a minute too. So you guys have great questions. You keep getting to my slides ahead of us. I love this. It's good. Medical payments. This basically is to avoid the liability lawsuit. So this is just no fault money, like, oh, you got hurt, here's $1,000. So it's good. You can usually endorse a policy, you get it to $5,000 for like $10 a year. So it's kind of a no-brainer to add this in every policy. You have a guest that comes over, they have to take an ambulance to the hospital. Maybe they have a couple $1,000s in medical bill. This will just pay it rather than them having to sue the liability portion of the policy. Okay, before this was going to click through, but I was gonna have you guys kind of go through this with me, but it's here. So what coverages are required? It's interesting, I'm gonna talk about this today, that there are some parts of this where the lending industry hasn't caught up to what maybe the insurance industry would like to see happen. So examples are here a little bit. Other structures, we talked about this a second ago. Yes, they need that covered because again, the casita is part of the value of the home, part of the loan, and that's why other structures, certainly they care about. Personal property, they could care less. That's your stuff. They don't care about that. That's not their interest, right? That being said, your client certainly cares, right? Loss of use, again, they don't care about that. That's you having a place to live. They don't worry about that. And then loss of rents, they do care, right? Because at that point, if you can't get your rent money back, they're afraid you're going to maybe potentially default on the property, right? So that's sometimes OMRO asks for certain requirements on things. These are the things we have to look at because some things the lenders care about, some they don't. Okay, so again, liability, not something you care about. Ordinance and law, surprisingly, they don't care about it. And they should, because again, you got to put sprinklers into a huge Victorian home now. It could be $75,000, $100,000. How is the client going to pay for that? Maybe they have to get another loan from homeowner to do it. I don't know. It could be tough. Medical payments, yeah, of course, they don't care about that. Okay, so this gets a little bit overly trainy of insurance, but really, you might have heard these before, a DP3 policy or a fire policy. That's just the base policy that you can get. There are DP1s first, and DP1 is named perils, meaning it's just as going to cover, and I'll show you right here. It only covers these 8 things: fire and lightning, internal, external explosion, windstorm and hail, riot, civil commotion, smoke, aircraft, vehicles, volcanic explosion. I mean, maybe in Mammoth you worry about that. So that's all it's going to cover. So that's really why DP1s have sort of been retired, just because the lender's not going to accept it. That's just not enough things to be covered. There are some exceptions where you can do a DP1 though, like on a renovation project, like Omer knows about this. If you're doing a renovation project, it might have to be a DP1, but then you can also endorse it to cover a few more things. So there are some ways around this now, but the whole policies are based off this DP1, and then it goes all the way up to DP3. Oh yeah, last one, really important, VMM coverage, vandalism and malicious mischief. I always love that word, malicious mischief. It's like the term in insurance, just mysterious disappearance, which is just you can lose your ring, and we say, okay, that's great, you just lost it. This other one, malicious mischief, basically vandalism, right? Someone breaks into the house for the most part. So the biggest issue with the DP1, it's ACV. And what is ACV? Actual cash value, meaning it's the depreciated value of that asset. So if the roof's depreciated, you're only going to get half the value of the roof. And then again, that's not something lenders will accept anymore. They used to actually, not anymore, and they should not accept it because that's not protecting the loan properly. Other part about it is it's all named perils, and then that got down too low, but doesn't cover theft. Or if it gets endorsed, it only covers theft on your property, where other policies will actually let that coverage follow you, like to your car, out of the country, even like a farmer's policy, anywhere in the world, 10% of it will cover you anywhere in the world. With the DP1, it would not even cover theft. If it did, it would not follow you. So there's some rules there that you gotta look at. Okay, best example of the DP1 policy, the California Fair Plan. I'm sure all you agents are pretty much locally here, just in California now. You've dealt with the Fair Plan before. It's kind of the last ditch, only insurance company will do it. It's through the state. State runs the department, the Fair Plan policy. It's very much a minimal policy where really it only covers 3 perils: fire, lightning, internal explosion, and smoke. So it doesn't even cover an external explosion. Oh no. Those are the only 3 things it covers. You can endorse the other 5. For sure, if I ever do a Fair Plan, I always endorse the other 5, and I add the vandalism and VMM coverage because it's really cheap to add it anyways. So the base policy has 3, but really you're gonna get those 8. But we just went through them. Those 8 are so limited. It really isn't gonna help you enough. Also, here's the difference. The reason why a lender will accept it is because the policy will qualify replacement cost as long as the home is 25 years or newer, or the roof is 25 years or newer. That being said, not all roofs are 25 years or newer. So the Fair Plan, I don't want to say it's a bad option. And these days, it's almost becoming your only option in some cases. I'll get to a solution we have for that coming up. But the Fair Plan is the best example of that. Questions? All right. Okay. Yeah, so again, the DP3 is the next step up. And I don't know, the DP2 has disappeared, so it doesn't even exist anymore. Forget about DP2. DP3 is the most popular policy when it comes to rental properties, and also people really are trying to minimize their costs when it comes to insurance. Maybe people aren't care about their personal property because the DP3 won't always have the personal property component that a homeowner's policy would. So it has a comprehensive list of perils, and it's interesting, really, you're better off if you are comprehensive, and then we have exclusions, right? And we all hate the idea of an exclusion, like insurance companies being mean, but you'd rather have a comprehensive policy that maybe excludes 10 things than a policy that only covers 8 things, right? So that's sort of the rule of thumb there. The key about a DP3 policy is it is replacement cost. And so you can get away with that with the lender, and sometimes it's the best option for your client. And again, if it's owner occupied, theft is usually included. On a DP3 though, normally, again, that theft does not follow them as they leave the house. And that's why a homeowner's policy is probably a better choice.
Percentage-wise, how much more expensive is the DP3 over the DP1? Is it 25%?
25 to 30%. And so sometimes it might make sense to do a DP1 and endorse it for the replacement cost. But again, you're really limiting those causes of loss. So we're going to get to it in a minute, but fires are the most tragic and I guess overwhelming thing can happen to the house. It's going to be destroyed almost in all cases. But what's the number one cause of loss? Anyone know?
Theft.
Not theft. A good guess though.
No.
Not even close. After fire, before fire, the biggest cause of loss.
Water.
Water, absolutely water damage. I don't mean floods or rainwater because it never rains in LA, right? I mean, toilet overflowing, an AC unit overheating. I mean, something like that where water damages the floor and you're not home. And then you've got a $20,000 floor issue. Water damages are just, it's what kills the industry in terms of the cost going up. Like condo coverage has increased because all these condos in Southern California were built in the 60s and 70s. The plumbing's starting to go and they're all breaking, and that is what's causing the condo insurance rates to just skyrocket. I'll send them one, they'll go, my God, it's $700, that's not a home. I'm like, yeah, but it's in an older apartment complex. The water damage is just extreme. So
Is it just water or is it mold as well?
it's mold as well, though mold's almost always excluded. So you can endorse it, it's usually expensive, but if your client's worried about mold, it's something we need to talk about because most policies exclude mold because mold is so hard to know if it's there.
What if you can prove you just got new plumbing? Would that bring the cost down?
It can, absolutely. Certainly on, that's a great question to answer too. If you know the plumbing's been redone or there's other permits have been pulled for new electric, new roof, getting that to the insurance agent can save your client some money, for sure. So I don't do it very often because the cost differential may or may not be huge, but if you know that stuff's been done, you have the permits, send them to the agent because you can get discounts for that, and it's all basically like new. Okay, occupancy, we talked about this already. Now, why do insurance carriers, why would they rather have owner-occupied policies? Any idea? I mean, it's there, but.
Because they're hoping that they're gonna treat it better.
Absolutely, they're gonna hope that they are. But yeah, generally speaking, your renter doesn't care about your spot as much as you do. So really, and that's why we would prefer owner-occupied, and lenders too feel that way a lot of the time, right? But certainly in the insurance world, we'd rather have owner-occupied. Doesn't mean that we can't do a rental property. It just means that it is a different risk to what the company looks at. And again, it really, the occupancy is going to dictate what's better. If it's a rental property, you can't even get an HO3 because it's not owner occupied. And the DP3 might work better anyways, as long as you have sufficient loss of rents, as we talked about earlier, right? That policy would be fine. And you don't need to add the personal property on because you're not living in it. Yeah.
Are you asking how much the rental is at time of insurance?
How much you're renting it out for? Yeah, I mean, a lot of times I get that information from you anyways, right? I mean,
but they say that's something else.
it is something important. I mean, it depends on the company. Like Farmers is already going to guarantee you a 1.5 year loss of rent, so it doesn't really matter as much what it is. But sometimes if you're doing an endorsement of another policy or you're getting a brokered policy, it's important to have that number. If it's $5,000 a month, they better have at least $60,000. If they've only got $30,000 of loss of rent coverage, you know that client's only going to have 6 months. A lot of the lenders will require at least 6 months of rents being there, and usually a year even. So, okay, let's see. Package policies. So we talked about the DP3s and that being more of just a fire policy. That's all the lender requires. They don't require an HOA as long as I'm an HO policy. But with bigger companies like Farmers and State Farm, we've created better products that are priced even more competitively and that are better. And that's a great example with the HO3. Basically, it takes the comprehensive coverage of DP3 and adds in certain included coverage as part of the package, right? Only owner occupied qualify for that, as I just mentioned. And so this is kind of the way it works. So let's say you're insuring a home for $400,000. The package policy will have, actually most of them was like 60% or 70% of personal property. So you have $400,000 to insure the home, a separate $280,000 just set off the package. That's kind of interesting though, because sometimes $280,000 is crazy. You buy a home for $400,000, who has $280,000 of stuff? Most people don't. We'll talk about that in a minute, but the base policies generally will do a certain number. So separate structures, automatically 10%. Even if you don't have an detached garage, your policy will give you 10% for that. The downside is you can't take it away, but it's sort of priced in already. So it's a package they get automatically. Same thing, 20% of dwelling coverage will automatically be loss of use. And then they don't take this number out of the 400,000. It's a separate 80,000 in that case for that. So it doesn't all come out of that same box. It doesn't. It's separate amounts. But again, the HO3 policy is set up to really be a package this way. But now what's happening now is clients have changes. I'm sorry, they have choices now. So one way to get our prices down is we said, okay, Omar doesn't want 70% because his wife stopped doing the handbag exception once they had kids, right? So now maybe only 40% is necessary. So I have a policy where I can actually design it based off how much personal profit they want. 40% sound right, 55%, 60%. So there's choices there. Because again, after a claim, they're gonna have a hard time justifying you had $280,000 of stuff. I've seen some of that where it's all these Gucci bags and Hermes bags, and the client's got to kind of come back and sort of say we have this stuff. That being said, all the fire claims that we had, farmers had a year ago now, we just cut out the coverage B. If you had $400,000 of personal property coverage and your house was destroyed, we just cut you a check for that amount. We didn't even worry about asking for receipts, and that's usually what happens in a big fire from the bigger companies.
Should you keep a personal inventory of your personal property?
Not a horrible idea. If you're going to do it, you want to do it on a computer. When I was a newer agent, I used to go out and really help people do that. Now it's hard to find the time, but I do encourage my clients to put it on a hard drive somewhere, especially items that will be hard to prove you have. Because again, that lady that had all these Hermes bags and other bags, yeah, pictures of that stuff's important, or old receipts. But if you have standard stuff, I wouldn't worry too much about it. Again, so now you can really endorse it for what you want, and that makes my quotes even cheaper, hopefully. For a while, their rates were getting a little bit high. Farmers came out with a smart plan, where now you can sort of change those numbers a little bit more a la carte, but it's still part of a package.
You didn't mention earthquake in anything.
I'm getting there.
Oh, okay.
Excellent.
Okay.
See, you guys keep doing this to me. I love it. And again, I'm selling farmers here a little bit, but a lot. We're the biggest multi-line insurer, so we give the biggest discounts. I mean, truly, if you do your auto, your umbrella, earthquake, life, you're going to get 35 to 40% off everything. It's a little bit like the Costco model, right? The more you spend, the more you save. You're going to spend more, but everything's covered. And so that's also why we like the HO3 policies. Us and every other company, though, if you have a DP3 policy, it does not qualify for discounts the same way. It just doesn't. It has to do with the profitability of these policies, I've been told. To me, it's a little crazy because if Omar has a DP3 policy for his rental, I'd love to be able to give him a discount on his auto, but it just doesn't work that way. It has to be a homeowner's policy that follows the auto policy. And then the umbrella. And even newer things now where you add an earthquake policy and Farmers now has a 5% discount on your auto policy. That's just crazy. Nothing to do with it, right? But just the fact that you're bundling everything, we keep giving you discounts. And so Farmers isn't the only company that does that, but we have the highest multi-line discounts in the industry. And again, not usually available with the DP3s. Okay, condo insurance. You're shaking your head already because this is a misunderstood demon out there. I'm really pretty good at this. I've become an expert on it. I've realized that that's why I get business, because I do know what I'm talking about here. It can be complicated for Omar and his team to figure it out. It gets down to the point where really it's different on HO3 policies. It's pretty consistent on HO3. They need replacement cost, has to be a certain amount. They want, guaranteed it's going to be rebuilt. When it comes to a condo, it's really hit or miss. It has a lot to do with the master policy that's in place, right? So I'll actually ask the client, can I get a copy of these CC&Rs? And these are 120-page documents, but there's a 3 or 4-page section that dictates the insurance. That's kind of how you know. Even then, it's not always clear. Then I'm gonna have to call the insurance company that does the master policy. If it's Farmers, I already know what it means, because Farmers condo policies, when we sell them for a whole complex, will actually rebuild the units all to the spec that they were in. Most companies do not, though. Most only go to stud, right? So that means after a fire, the HOA policy will rebuild everything except for the floor, except for the cabinets. Kind of a big deal, right? To your client and certainly to the lender, right? So that's why this is so important. And again, where you've got to really do some homework, look at the CC&Rs, look at the master policy. It can be complicated. Another aspect too, and I thought it was an FHA loan, but Omar and I were speaking before the meeting. I don't think it's an FHA loan requirement, but different lenders have different requirements here. What building property is on a condo, it's the walls in coverage. It is the cabinets, it's the flooring, everything I just talked about. That's what's considered walls in, right? To stud, basically. So everything inside is walls in, or what we call building property coverage. A lot of lenders now are requiring 20% of the appraisal price. 500 grand, you're gonna need $100,000 for the inside. Honestly, that number sometimes is way out of whack because it's, just a standardly built inside, but that's what they're requiring. And so that's what you have to have in the policy regardless. The building property coverage isn't all that expensive though. So if you have to go up to 100,000, it's not the biggest deal in the world. Again, they want to make sure the interior unit's rebuilt properly back to how it was, right? Because that protects their value. And that's what I talked about already. The HOA policy and the CC&Rs really are going to help guide us on what they need. And again, we go back and forth, Maria and I have gone back and forth trying to figure out what it requires. And then before close, though, it's different. They didn't actually need it. Like it's just be patient with these HO6s. It can be a little bit of a pain in the butt, but it's really important that the clients insure it right. And then it even gets into earthquake coverage, which is unique because you can add it on a condo, but if the master policy doesn't have it, it's kind of a dumb thing to buy because they're not going to rebuild if there's no condo policy, right? So while you're buying a condo, there is a reason why. You can protect like $100,000 of your equity, but the condo earthquake policy could be $1,000 a year. I have a few people that have bought in it, but still, it can be a little complicated when it comes to earthquake component as well. Questions? Yeah.
So what I noticed is though that like 75% of the condo complexes don't add inside walls HO6 into their master policy because obviously it costs more money. So yeah, you're paying HOA, but they're not covering it. So when we do a loan, there's, even though it's a condo, there's an additional insurance requirement. And that could be now, like you said, like $50, $60, just as much as a house.
Yeah, I mean, you're going to pay for one or the other. If they had gotten the master policy that included it, the HOA every month is going to be $50 more, or the policy they're going to get from me is going to be $20 more, right? So same thing with earthquake coverage. Condos should all have them, but I think 15% or 18% in California have earthquake coverage. Why? Because your HOA dues would go from $400 to $900 a month, and no one wants to buy the property. Granted, the good owners go in there and they realize that problem, they get on the board, and hopefully they then will add a master policy, and then it works out a little bit better. Going into a little bit more, building property coverage, the walls in coverage, and then loss assessment. Anyone know what that is? Loss assessment coverage? Any idea? This is just basically after a loss, the association is going to, the HOA is going to assess everybody a certain amount of loss. Like, okay, one of the units burned, there's some common area burned, $100,000, there's 10 units, everyone owes $10,000. It's part of what they sign when they're signing their CC&Rs and buying the condo. These policies include loss assessment, up to $50,000. A lot of times I'll see a competitor send a quote with no loss assessment, which, as you can understand, that's really bad. The dumbest thing about it is $50,000 of loss assessment coverage is $18 a year. So it's such a no-brainer. If your agent sends you a quote without that, that's not a good agent because $18 a year, they have to have it. Yeah.
50,000 a year or just one time?
50,000, but it's unlimited how many times it can be used. Yeah, I mean,
That's huge. And how much is that?
It's $18 to go 50,000. You can do 10 for like 2. I mean, it's an endorsement you have to add to the policy. Some policies have it automatically, but I've seen quotes that don't even include it, and I don't know what that person's thinking when maybe they just forgot to add it, but it's a super important coverage to have and to explain to the client. Again, the condo ones, these get a little complicated, but that's what loss assessment is. Otherwise, it's a lot like a renter's policy because it covers their personal property, covers liability. And what the insurance companies care about is just the building property coverage we talked about. So, questions on the HO6?
We're just to redefine this is covering inside walls. That's not the studs. They're just gonna put the studs and maybe the drywall.
They'll probably put linoleum in. It'll be
master
basically
policy.
just really builder. Yeah, really, like you said, it's dependent on the master policy they have.
If they don't have HO6, you have to have HO6 to build the rest of your house inside.
Yes.
Fixtures and floors and cabinets.
And
If the master doesn't
If
have
the
it.
master,
If the master doesn't have it, and
That's why you-
most don't have it.
yeah, 'cause it's expensive.
But sometimes they require, but they don't have a limit. You know, you put $10,000 isn't there enough, right? But again, there are lenders that want the 20% number, and I'll ask Omar, is this 20% deal? They say, yes, it is. And then I know that's what I'm going to quote it out. And then it's really important, if you have a highly upgraded unit, it's important to tell us too, so I can add even more of it. Maybe the 20% is not even enough because they have all granite, amazing floors, all this kind of stuff. They're in a penthouse unit. They're going to need a lot more coverage in the building property. So, yeah, please.
Do these rules also apply to co-ops?
Yes, in California, they do. They do. Absolutely, good question. Other states, it gets a lot more complicated, but not in California. Luckily, less complicated in California, which is an odd statement because that's almost never the case. We're getting to that part later, right? That's coming. That's coming. Okay, other policy types, vacant policies. Again, we hate vacant homes. Why?
Vandalism.
I mean,
so forth.
not even the owner's not there. No one's there, right? So vandalism, absolutely. And that's why we don't like them. Doesn't mean we won't do them. It just means you're going to pay. The rate's going to be up there. And we don't like them for vandalism, mischief, the VMM again, squatters, all that kind of stuff. Again, premiums much higher to reflect this risk. And there's a difference between someone buying a home that's going to be vacant. They're probably going to fix it up. Maybe it's a flip, or maybe they're going to leave it vacant for a while for whatever reason. That's different though than if someone's buying a home and they don't do a rent back to the person they bought it from, right? And it's just vacant. They don't take ownership for the first 60 days. That presents a real problem. You'll get a decline because basically, we'll talk about it in a minute, but farmers will send out a third-party inspection company. And if they can tell it's a vacant home, we'll decline it. We'll give a 45-day notice legally because we have to, but we do not want to insure a vacant home. If it's in the first 30 days, we're okay with it. They're moving in, that's okay. But if it's after 30 days, some companies 60, it changes the policy. Basically, if you have that policy, if there's any vandalism, it will not be covered in the policy.
What about all those homes in supposedly San Marino that's sitting empty from foreign buyers?
Yeah, that's a great question. I mean, the thing is there, the inspecting company can't get in to verify that.
There's
So that's,
no graffiti or.
and you know this is because the rich have different rules, right? So great question, yeah.
Homeowners have vacant homes, wouldn't that be a good source of revenue for you? To say, hey, look, your insurance rates are gonna be higher, why don't you rent this out? Where can that pressure be applied to them in a good way? Can it be,
That's a great question.
I mean, it's city policy. I mean,
It
I
is.
know for a fact, that I think it's in the Star News right now, they're talking about vacant homes.
Right,
It's an
Yeah.
article.
lots of them.
It's a real problem. And I mean, honestly, insurance rate wise, you're gonna pay at least double. If you're gonna pay $1,000 on homeowner's policy, if it's vacant, you're gonna pay $2,500. And that rate's actually going up now just because insurance companies, all the fires have really freaked a lot of companies out in California. We're about to get to that, but it's just getting harder and harder right now. That's a great question. Yeah, there probably is a good solution there with some of the homeless problem, getting people into some of these places because they're gonna take care of the house better than it being vacant. So vacant really is an eyesore for the neighborhood. It brings property values down. You're right. But like I already showed you a lot of disconnects between lenders and we're not on the same team, unfortunately. So it's a tough one to respond to there, but I'm totally with you. But again, important to tell your client whether or not they intend to take occupancy right away, or even telling me okay, they're gonna do a quickly remodel the kitchens, great. But if they're gonna do a major renovation project and you know it, tell the agent because it changes how I would do the policy. I actually would set up a course of construction policy or even do a renovation policy is what I would do in the first 60, 90 days. Because again, if the insurance company gets out there and they're breaking down walls, that policy is gonna get declined. The agent's gonna get in trouble. Omar's gonna get contacted. Why did you send me to ARM? This is wrong. It's because no one told me that was happening, right? Client doesn't tell me. If you guys know, tell the agent so you can avoid some pitfalls later.
I was gonna send it to Aaron, not Arn.
I know, that's what I said.
You got it wrong.
It was that Aaron guy.
That's an advantage, man.
He screwed it up, yes, it's Aaron. If you like my presentation, it's Arn. If you hated it, it's Aaron. Okay, so we just talked about this. Vacant and construction, that's like a double whammy, right? Because construction brings all the different risks involved with that, certainly stuff getting stolen. Difficult, not impossible to place. Generally speaking, what you want to do though is if there's a licensed contractor, the contractor should have course construction policy. The risk could really go on your contractor. That's why you're paying the contractor. That being said, a lot of people don't use official general contractors or licensed contractors, and that's why they want to place their own policies. If there's a pool, then it gets really hard. Vacant construction in a pool, almost uninsurable. And vacant in a pool is pretty darn hard as well. I have to really look for that policy because vacant already in pool, someone's worried about a drowning, you get it. Those are hard to insure, not impossible, but hard.
So what I'm hearing you say is that you're not just doing this to farmers because you're a brokerage. You're able to go outside of farmers and place these hard to do.
We have to because the bigger insurance companies have gotten so scared of some of these risks. When it comes to fire, earthquake, companies don't do that separate now. It's becoming that where insurance companies are just saying, we can't handle this amount of risk. We're going to scale it back a bit. So I do have to broker stuff. And farmers allows me to, even though I'm a farmer's connected person, I'm supposed to have everything for farmers. If farmers declines it, I can take it into the broker market. And that's becoming more and more possible these days. But I'm about to get to it. There are some solutions farmers, other companies are coming up with to sort of figure out a way to keep part of the policy and also transfer some of the risk. So big part people forget about there is the premise liability. So not just the lender's only going to care about the construction and making sure it's insured properly for their loan, but the owner really worries about the liability. Because again, if someone gets injured on the property, they can get sued and lose the house anyways. So making sure they have premise liability when it comes to renovation is important. Okay, so this is some of the challenges we have. Insurance companies require agents to inspect all properties before they bind the policy, which is really hard sometimes. If it's a policy all the way out in Inland Empire, I may not get out there. I might call another agent to do it, or if I get an appraisal from Omar, a lot of the reasons I'll ask for the appraisal is because I want to see the recent pictures. Granted, sometimes those appraisal pictures aren't all that great, and the roof is questionable. So we're about to get to that. The number one reason for decline is, I just said it, the roof. Condition, and Omar knows this for sure because we've had conversations about this more than once. And that's partly because farmers has gotten really conservative when it comes to roofs. A roof that's starting to curl or the wear, or it's called granular loss, they might decline it. Now, that roof might be fine for 5 or 6 years here in California because we don't get a lot of rain, but the insurance companies really don't want it. And farmers is not the only one that's tough on roofs now. That's pretty much across the board. That being said, I mean, you could look at like I'm the agent there, they got the home, it declines after they already bought the home, but you guys are all great agents. The service doesn't stop there. You send them to me and I send them a policy and then it gets declined. They're gonna call you and say, why did you send me to ARM? What the heck? It's an uncomfortable situation to be in. So that's why a lot of these times I gotta go out and inspect. Now, not all agents do it all the time. So all companies send out a third-party vendor. Usually a drive-by, usually pretty quick. We hire someone else to go out and do it, and they'll send pictures in, and farmers will determine based off those pictures if we should stay on the risk or not. If we don't want to get out of the risk, we have to wait 45 days. Farmers hates that. You insure a bad property, it's on the agent for the first 45 days until we can get out of the risk, right? In cases like that, though, then if we know it's a bad roof, I can look around and find another insurance company. We have a partner, Foremost, that will take a home that does have a questionable roof. That's why it's important to know ahead of time so that I set the policy up right, so we don't have to worry about decline once they moved in, right? So there it is, bad roofs, excessive wear and tear, curling, lifting of shingles, granular loss. These are very obvious. Sometimes I'm telling you, the underwriters are super nitpicky. I mean, Omar had a couple of these, and then some of them are able to just fight back with farmers, send a different picture, and I get it approved. So it's kind of a work through process, but roofs are the thing that are going to get your homes declined the most. Other things, a super cracked driveway is an issue because of liability claims. Cracked foundation, that's a no-brainer. They're going to decline on that. Deteriorated stucco, peeling paint. If it's as bad as the one on the right, that would be a tougher house to insure. It would probably be one of those DP1 policies endorsed. Deteriorated stucco, though, that just might be something where the underwriter will say to an agent, hey, it's okay, but just mention to the client that something they might want to clean up, which is tough to me. I don't really want to tell them to clean up their house, but that's kind of where you're going to go. Generally, this is why you inspect it ahead of time, and then I know what to tell Maria or Omar or the lender, how we're going to work around some of those issues. Okay, any questions on any of that stuff I just covered? Yeah.
So those were roofs that are just like bad wear and tear, but are there certain types of roofs? Like there's like the Spanish roofs, or there's that other one that looks like ranch looking one. I don't even know what that is.
Yeah, I
I don't even know what the name
mean,
is.
the ones that have become tough now, and you see a lot of it in San Marino, is the wood shingles, right?
Yeah, it's wood shingles.
Wood shingles, and that's a fire hazard now. So those used to be very much acceptable, and now they're really not very acceptable. So people that have a grandfathered in already might want to keep that policy because companies just don't like the wood shingle because
So they would
Nash.
let you see it.
Well, we can still do it, but it really depends on the area, depending, right? So if anywhere near the hills, wood shingle's a no-no, and then I have to find another place for it, and that has gotten really hard now. Yeah.
Quick question on replacement cost.
Yeah.
I wanted to throw it out before you continue.
Sure.
Say you have a home, it has a swimming pool with a diving board, but for some reason the diving board gets destroyed. You're not allowed to have diving boards anymore in most neighborhoods.
Right.
Do you replace it because it's grandfathered in? Do you replace it because there was a diving board there, or up to code now where there are no diving boards allowed?
Man, it's just like an insurance adjuster. She's good. So legally, the person's entitled to get the money for it, and it would either be rebuilt or they could just get the money for it.
But you're not allowed to rebuild it if it's up to code.
So then they'd have to get the money for it. The only other problem too, though, is, and we'll get to it too, is that, you're not gonna have damage in a pool anyways. I mean, it doesn't generally burn.
No.
Has to do with maybe an earthquake. The earthquake policy is tough though, because really, most earthquake policies don't cover pool damage. There's a downside there. You can get one, but they're like 4 times the cost. That being said, depending on the client, it could be a real important thing to make sure that pool's covered, right? So that's something to think about. I'm gonna talk about the CEA, which is the most popular and the best price earthquake policy out there, which I offer. But that one doesn't cover pools. Oh, it does to like maybe $3,000. It'll cover if the pool leaks into your house or floods your house, but it won't cover the rebuild of the pool. And that can be a big issue. So then again, the earthquake policies always have a big deductible. So if you're already losing the money on, because they will take the pool cost as part of your deductible. So it sort of washes out, but that's a great question. In the end, insurance-wise, you're entitled to at least get the money back that was there. So the value of the diving board would actually be given to the client, but they would not be allowed to rebuild. Or I guess they did, they could get in trouble. Depends how risky they want to be. Certainly when you go back to vacants, if it has a diving board, then forget it. Pool, vacant, renovation, diving board, no one's going to insure that property. Just throw in a vicious dog and just forget it. Okay, so challenges. We've all seen these. I live in Valencia. My kids were evacuated from their school last year. The wildfires and what's happened is just crazy. And we're not going to get into the politics of all that and decide who to blame, but probably just the lack of rain causes it. But that 12.4 billion number has actually even gone up. I saw that last night, then I saw another figure that was like 18 billion. The reason insurance companies don't go out of business on this is because we all reinsure. So I read that farmers' losses were about 2.6 billion, but I think it actually only cost us something like 500 million because we reinsure it in the reinsurance market. The problem now is after these losses, the reinsurance rates for us are so much higher. This is why you see all the rates go up. But we're not legally allowed to just surcharge a certain area. So basically what you're seeing is every company have about a 6.9% rate increase. Why? That's because that's the max the Department of Insurance allows in a year. And so basically every company has taken 6.9% rate in the last 12 months, all because of the fires we all lost millions in, right? And the reason we have to raise the rates is because our reinsurance costs went up. It's not because we paid $2 billion, because we reinsured it. But the reinsurance companies are not giving us the same prices anymore because they took a bath right now. Okay, so fire danger, and this is one you guys all deal with, right? This is a huge issue, trying to make sure that definitely when you have your clients buying the houses up there, up in these areas, and now even further down, they're still considering even just a further south even still might have fire danger associated with it. They're gonna have higher costs when it comes to insurance. There used to be a lot of special terms like SHIA zone and fire line score. That's still there, but really what's happening now is if it's in a brush area, companies don't want it all anymore. Farmers used to write just about all the way up the top of this hill, not anymore. We're down maybe about a mile north of here, and then we don't like it anymore. So it's gotten really hard. Like I recently did one for Omar, and it took me 3 or 4 days to really get the combination together for his client. And that was just the north part of Monrovia. But going up to inspect that guy's house, there's a sign that says, "You're entering severe fire danger." I've never seen a sign like that. And I was talking to his client, he goes, "Yeah, because there was one of those fires from a year or two ago was right there." And so that's what the neighborhood did, is they basically had signs up. So the idea is make people be more careful. But I've never even seen a sign like that. So I drove past that and thought, oh my God, this policy is going to be $20,000 a year. Not quite that much, but it was a lot. Okay, so there are still brokers like a Stillwater and Lexington that will do them, but that's becoming a little more uncommon. And when you want to quote like that, the turnaround time is not, I need it in a day. It takes 3, 4, 5 days, a week. They're slower getting back to us. They're really picky. They might send an inspection company out there. And it's in the surplus lines, which isn't necessarily a bad thing, but that just means it's not written by a company that does business in California, which it could be a bad company, or it could be like Lloyd's of London. Super successful, A+ rated, but they're in London, right? They're the headquarters. Surplus lines is not necessarily a bad term, but that's where it might be available. However, there's a new solution now, and this gets complicated, but it really is a great solution for the fire problem right now. And that's what's called a RAP, or a DIC, Differences in Conditions Policy. We do call it the DIC sometimes. Yes, it's funny. Really, what happens there is basically there's 2 policies, right? You have the fair plan policy. It covers fire, mostly only fire, right? And then farmers, Travelers has it, Safeco. There's about 5 or 6 companies that are doing these RAPs right now. It's called a RAP. Right now, one of the problems is it's only available on a homeowner's policy. So if you have a rental, I have one of these now that I cannot find a home for. It's in Santa Clarita. I thought it was a homeowner's policy. It's not. They're going to rent it out. I cannot find a home for it. I cannot find an agency that will do it in that fire area as a rental, right? But for a homeowner's policy, that's the solution. Omar's client in Monrovia, this is exactly what I did. I'm going to sell the fair plan policy. It's going to cover the fire. And then you're going to have the farmer's policy cover everything else. And why is that so important? We talked about it. Water is the number 1 cause of loss, okay? So here's the interesting thing. All that Omar would need to close that loan is a fair plan. That's it. That's all they care about, which is really crazy, right? Because the lender is not worrying about water, right? But they don't. All they legally have to required for by the state is all they can ask for is fire insurance. So the fair plan will do it for them. The problem with the fair plan is it has no liability, and that's huge. You know, a dog bites, someone slips on your property, you could lose your home because you have no liability. So the fair plan is very limited. That being said, when you bring the RAP in, now the liability comes from farmers. Now the water coverage, everything else you can think of is covered by the farmer's policy. So this is a good way to, you know, basically insure it now with 2 policies. The problem is it's really hard to explain to the client. It's complicated. And also the coverages kind of have to match. If you're going to insure the house for $450,000 in the farmer's policy, it has to be the same $450,000 on the fair plan policy. You cannot have a different number because they have to work in concert together. So these get complicated. You know, and then what comes in after is there are situations where you do need, okay, interesting. So they don't require the water policy to cover the rest of their home, but certain flood zones in Southern California and in California, you've heard about it, they've required flood coverage. Most common ones generally are Palm Springs, but there are places in the middle of LA, like near La Brea and Slauson, flood zone, just a few block area. So interesting when those things happen. Flood is also done by the National Flood Insurance Program. And so you all dealt with some flood occasionally. We don't deal with a lot in California, but it's one of the 2 things that aren't covered by major policies, right? Flood and earthquake are separate, right? So we don't have to go a whole lot more into that. Questions on flood? No, right? Okay. Okay, one thing about floods though that's interesting is that they're the only policy that covers mudslides. So the clients that I do talk about to flood to are people that are in the fire zone already. Granted, they're already paying a whole lot. Now it's like you might need a flood policy too, because it's really the only one that's going to cover a mudslide. So that's just one area to think about when it comes to flood. But at that point, that person's buying 4 policies and they're spending $10,000 a year on insurance if they're adding earthquake too. But it can be necessary depending on the house, and if it's an area where mudslides occur, might be something to talk to your client about, or something I talk to my clients about that are, in these brush areas. Okay, earthquake, we talked about it a little bit earlier. Again, surprising, lenders do not require earthquake coverage. That's crazy. If I was a lender in California, but this is just like the fact that people can have insurance and only have $5,000 of property damage when they're driving around. So somebody hits you in the street, the minimum they have to have is $5,000. So they could total your car, the insurance company have only going to pay $5,000. That's why it's important to have good auto insurance in California, because basically we're trying to keep the costs low for everybody, right? That's what California is, right? So the same thing with earthquake, they're not requiring it. That being said, as the client builds equity, earthquake coverage is so important to protect your loan, right? Before 1994 and the Northridge quake, insurance companies just included it as part of your policy. After Northridge, all that money's paid out, the companies got away from it, and the state had to come in and create their own situation, which is the California Earthquake Authority. There's 28 insurance companies in California that can actually work with the CEA. Other companies cannot. Other companies might have access to Gia Vera or a couple other earthquake policies they can sell, usually which are a lot more expensive. Some, though, do have the advantage of a little bit better coverage for pools, potentially. I can also broker those because we don't cover the pool, or the CEA policy does not. But this is another solution where the client can make sure they have something to cover earthquakes. We talked about the different coverage amounts, loss of use, personal property. The CEA policy is not a package policy. You can just have it for the home, no personal property, or you can have it with $200,000 of personal property, or it's really a la carte. And so that's what's tough when the client wants a quote. I can't just send them a quote. I really have to talk to them, get an idea of how much coverage they want, or I have to make some assumptions about what they have, which I don't like to do. And then, like I told earlier, Farmers gives you additional discount on the home policy. I think it's 5%, and then on auto also 5% if you add an earthquake policy. So it can be something that's good. That's all I have. But questions? Yes.
How many people are using the wraparound loan? Are you a good aid, like not just can they be talked into it? Can they see the value?
A lot of them have to at this point. Like, it's the only option. Like, I hear you, but you're right. It does get complicated. That being said, they can just go with the fair plan. But as an agent, I don't like selling it that way because, again, it only covers fire. That's it. And fires are the most catastrophic, but most people don't have a home fire. It's just very rare, right? So, yeah, the wrap plans are becoming more and more popular. Again, as a lot of the surplus lines and other companies got out of the fire danger areas, the wraps are becoming the only solution. And again, where it's just tough for me is it's hard to explain to people. And then it's also tough when it comes to evidence of insurance because, again, the lender doesn't care about the farmer's policy. All they care about is the fair plan policy. And that makes things a little trickier on that part of the deal.
And I would think if you're a real estate agent, just listening to everything you're saying, I wouldn't want to sell in an earthquake zone or fire zone particularly where it's outstanding on a map. Does that make sense?
I would just say be wary. Let the client know that, okay, we're getting you a great deal on the home, thank God, because your insurance is going to be a little higher. And the key there is don't wait until you're in the 30th day of the loan to secure insurance. Start as soon as possible because it can take a week to 2 weeks sometimes. I mean, maybe quicker. Right now, just hard, but not hard like with the wrap, like the one I did for Omar's client. I got it done in a day. I could figure it out. But it was a matter of really explaining to his client in that particular example why he needs to. And he had great questions about why doesn't this match and why does it work this way. And obviously, the farmer's wrapped policy is a lot cheaper. It's something like 40% off of what a regular farmer's policy would be. Why? Because it doesn't cover fire. And so you're going to get a better deal on that part of it. And so it all kind of does work in well. Granted, when someone wants to add an earthquake too, then it gets really complicated. But that's what I'm here for anyways. And I like that kind of stuff. It's actually fun to kind of work through it.
Question, if let's say a kitchen burnt down in a house, how do they figure out how much they're going to pay out just for the rebuild of the kitchen area?
That's a great question. Again, it's just where I did the 360 value right, or the cost estimator right, and I put that it was upgraded. And so part of that actual 360 value will say that it's a $50,000 kitchen plus an extra $25,000 for that reason. That's why it's important to insure it for enough. That's also why you get some companies that insure it for way more than they need to. They're never going to spend all that money on the claim. So, good question. Yeah, please.
Oh, okay, now, as a homeowner, should we be letting you know when we do upgrades on our homes?
Yes, great question. I mean, upgrades, depending on what you're doing, but if you're adding value, sure. Certainly if you're adding, especially if you're getting what do you call them? The solar panels, for instance, that's a big one, especially if now you're buying and they're part of your, you're getting in on a long-term deal, it's part of the property. So yes, making sure that your clients tell the agent when they're upgrading things, because you've got to increase that amount of insurance that they have. Otherwise, the companies are going to kind of raise that by about 3 or 4% every year for inflation reasons. Yeah. So if you start at $400,000 in 10 years, we're probably insuring you for closer to $500,000. But if you added a whole new brand new kitchen, we might have to add an extra $50,000. And Interesting though, it doesn't cost a lot more. If you add $50,000 of coverage, it might be an extra $70 a year. It's not like it makes the policy double in cost.
Because I'm reviewing it, that's why some people are kind of like, well, I don't want my insurance to go up, but you want the
It
coverage.
doesn't go up much, yeah. If it went up a lot, I get it, but it doesn't.
Or do you do commercial real estate too?
Yes, absolutely. And again, the rules for commercial real estate can be different too, when it comes to vacant and different rules, and the lenders certainly have different rules. So good question to ask. Yeah.
Cool.
All right, thank
Thanks,
you,
Aaron.
everybody. I
Give a
really
round of
appreciate it.
applause.
Thank you, Oren.
Thank you, Oren.
Okay, good. It's good. You said Aaron instead of Aaron.
Oren.
All right.
Do you have a business card?
Yeah, I do. And then if you guys all